Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a huge welcome to the community. We can't wait for you to get stuck into this episode with us. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. It's almost the end of Super September.
Yes.
I hope everyone has been thinking about their superannuation and how they can improve it. Or just get it right for the year ahead, because we're going to do it all again next year.
Absolutely. Can't wait for the return of Super September 2025. We have a big episode today.
Yeah, so we're going to start with the news. There's some big stories making news here and around the world. Then we've got a number of experts joining us today. We're going to speak to Nick Cregan, who is a partner and portfolio manager at Fairlight Asset Management.
Can't wait.
And then we're going to close it out with another Pimp My Portfolio. Luke Laretive from Seneca Financial Solutions will be joining us, and we're going to be pimping a portfolio from the Equity Mates community.
Gosh, what an episode.
Big episode.
Can't wait.
Let's get into it.
News and markets.
Well, we want to start with a story of beggars.
Beggars can't be choosers.
Beggars can't be choosers.
And here's the thing. No matter how much money you have,
Yes.
you sometimes still need to beg.
Larry Ellison, the third richest man in the world.
Yes.
We had Elon Musk, the richest man in the world, begging Jensen Huang, in the top 10, definitely in the top 10. I think he's 100 and something billionaire.
You keep telling the story. I'll find where
one
he
of
is.
the richest men in the world, begging Jensen over dinner for more chips from Nvidia.
Literally all the money in the world cannot buy you these things.
That's it.
So
it is incredible.
Jensen is 15th on the Forbes rich list, net worth of $100 billion or $99 billion, the founder and CEO of Nvidia. And then Elon Musk, number one at $250 billion. Larry Ellison has recently had a big jump up, number 3 at $200 billion, the founder of Oracle.
Yeah.
And they cannot get their hands on these Nvidia chips.
Ellison actually quoted that he said to Huang, "Please take our money. We need you to take our money." And he still couldn't do it. It's just it's incredible what's going on for the demand for these chips. And apparently Ellison and Musk are now trading between them for various different reasons. But
it just makes you think that some of Nvidia's recent wobbles, it fell 20% like less than a month ago. Before that, it sort of fell almost 30%. But it's like, put the share market to one side.
I know.
Think about the business fundamentals,
Yeah.
and think about how many people are desperate
Yes.
for these chips,
Oh.
and how many people can't get a private dinner with Jensen Huang,
Exactly.
but are queuing up to get these chips.
exactly, it did really make me think about. Well, I'm not invested in it.
Well, you are through your index fund.
True, but I was just like, this is classic.
Yeah.
Anyway, but the main thing is, it actually got us thinking, like, Larry Ellison, just like that, not under the radar billionaire, but just he's done it. He's achieved a lot.
Yeah.
But who is he? What does he do? Oracle.
That's the title of the episode.
He's achieved a
Larry
lot.
Ellison has actually achieved a lot.
Good on him.
But you're right. Oracle and Larry Ellison don't get the play that the Microsofts, the Googles, the Amazons do.
Yeah.
It's not quite as big. It's about $500 billion, $500 billion market cap, but it has had an incredible year. So we wanted to just pause and talk about Oracle for a second.
Yeah.
So the Oracle share price is up 58% this year. And Larry, as the major shareholder, is now the third richest person in the world. But what does Oracle actually do?
Tech.
Well, yeah. It's a software company mainly focused on enterprise software. So database management, enterprise resource management, human resource management, supply chain management, all those corporate buzzwords.
Yeah.
The way I would analogize it is if you think about Microsoft as the world's biggest software company, it creates software for consumer applications. And obviously businesses use the Office suite as well, Office, Word, Excel, all that stuff. But it's like we use it, we see it, we download it, we pay for it.
Yeah.
And so we really are familiar with Microsoft software. Oracle is B2B software. It's software for businesses, and you might have used it or SAP, the German SAP, if you're at a big corporate and you're trying to log your sick leave or you're trying to request annual leave and stuff like that. It's like they're the kind of platforms that these companies make.
Yeah, but you saying that then it's kind of like, has that been the reason the stock's up almost 60% year to date? It doesn't feel like the sexy part of the business that's driving 60% growth.
No, you're right, because whilst it has its roots in a software company, like so many of these giant tech companies, it's now also in cloud computing, data centers, and AI.
Yeah.
And that has been the driver, AI. Because, surprisingly enough, Oracle's cloud infrastructure business, which competes with all the big giants, Microsoft Azure, Google Cloud, Amazon's AWS, Oracle has actually built a reputation for success with the workloads required for generative AI. And in some ways, they've been doing better than some of these other big tech players, and that's why their revenue is growing, that's why their share price is growing. Their most recent update, they forecast another 55% growth in revenue in their cloud infrastructure business.
Love that.
So they're doing pretty well out of this whole thing.
Well, get this. Here's a stat for you to kind of back up how they are really investing in this. They are building a data center that is going to be powered by 3 nuclear reactors. And within that, they're building a supercomputer that is going to use up to 131,072 NVIDIA Blackwell GPUs.
Nice.
Massive.
It's interesting because
3 nuclear reactors to power this bad boy.
Well, I don't think are they saying that all of the power generated by the 3 reactors?
Yeah. Building a data center powered by 3 nuclear reactors.
Okay, yeah. I'm still a little bit skeptical by that wording.
Wow.
That's amazing. But I think just the Blackwell chips, so that was one of the reasons that NVIDIA had a wobble a little while ago, because people were questioning the timeline that these new generation chips, these Blackwell chips, would come out, and also were they as good as everyone thought they would be. The fact that Oracle alone for one data center is going to buy 131,000 of them. Billions of dollars. Yeah. So, like, this isn't a buy or sell on NVIDIA because, how much of it is priced in, what comes from here. Like, there are a lot of questions to ask if you're going to put your money into an individual stock. But I think the business story is pretty rock solid still at this point.
I would argue that Jensen is currently is the second most powerful person in the world.
Who's the most?
US president.
Okay, interesting. Yeah, sure.
He's got billionaires begging at the feet. Anyway,
the US. I was about to say the US president doesn't have billionaires begging, but they probably do.
They do.
Yeah, or billionaires writing checks, but that's another story.
Yeah, that is another story. Well, let's move on. Another headline that we're following closely, I think, because
let's say another headline that's reared its ugly head.
Yeah, which is superannuation for housing, a policy that has come from the coalition that we've spoken about on the show, where they're really trying to allow people to take superannuation to buy property. That's what they're trying to push.
Yeah. So the policy is first home buyers would be allowed to withdraw up to 40% of their superannuation, which is, for non-Australian listeners, your tax advantage retirement savings account that you shouldn't be able to access until you reach retirement age, like your 401k or your lifetime ISA, depending on where you're listening to this. Withdraw up to 40% of their superannuation to a maximum of 50 grand to help fund their investment in property. And then in the future, if you sell that property, in theory, you return your money to your superannuation account.
Yeah.
Now, if there's one thing that we've learned about Australian politicians and their incentives, is that housing affordability policies are really code for housing pumping
make people
policies.
buy housing policies.
Every affordability policy does not make housing more affordable.
No.
It puts more money in people's pockets to pump the shit out of this market.
More into the system.
And this is just another pump. No, I was about to say pump and dump scheme, but there's no dumping. It's just pump.
It's just a pump scheme.
And like we reckon, like, it may be well intentioned. It may be that like there's a pool of money here that people should be able to access. And it is true that you're better set up for retirement if you own your primary place of residence and you've fully paid off that mortgage. That is undeniable. The problem is this isn't going to help people get into their first home. The first reason, it's unfortunately just not going to be enough money in most cases. So this is analysis from Saul Eastlake. For Australians aged 25 to 34, nearly 80% of them would not be able to withdraw more than $20,000 under the scheme. So it's just like the quantum of money we're talking about compared to the size of the housing challenge. Not quite there. But the second and more important problem, it advantages older Australians and it advantages wealthier Australians.
If you keep in mind that 25 to 35-year-old bracket, this median super balance for that age group will only be able to withdraw $18,000. What effect does this have? It really only increases the total value that you can put into a home by $90,000, presuming that the banks adjust their loans accordingly to reflect essentially an increase in 20% of your deposit. But as you said, Ren, like $18,000 on what now in major capital cities, deposits need to be in the six figures. Not really going a long way. But the median, if you compare that to the older generation, the median couple aged 45 to 65 could spend $400,000 more in comparison with their increased loan and the deposit combined. So all of a sudden you see the huge discrepancy between what the boomers could go out and buy and what those that actually need help and support, the impact that it's going to have on them.
Yeah, every first home buyer is going to have more money to spend. It's just that young people are going to be disadvantaged relative to older Australians with more in their super who can draw more.
It's going to do nothing more than keep the divide, but just increase house prices.
Well, it will definitely increase house prices. But it will also be the case that people who earn more and are wealthier have more in their super, and then they can draw more as well. So it's also going to increase the income inequality divide because those that have higher incomes will be able to afford more because they can draw more from their super than those on lower incomes. So it'll exacerbate the age divide, it'll exacerbate the wealth divide. And the third thing is it will be a massive hit to people's retirement savings.
Yeah, that's the
And in many cases like an unrecoverable hit. You know, we talk about one thing that we modelled out in the book, I think we probably did it in both books, but definitely in Don't Stress, Just Invest. So if you want to see all the data, you can pick it up. But you model out someone who starts investing at the age of 20 and stops at 30 compared to someone who starts at 30 and invests the same amount as that person was doing and at the same frequency in their 20s. You can't catch up.
No.
Like that extra 10 years of compounding, just as the market ticks away and you take the market's average return, it's so hard to catch up. And that's essentially what we're going to be subjecting people to if we say, hey, pull out almost half of your super and then play catch up. And, you know, obviously you hope that house prices grow and the money compounds that way. But, you know, we've seen over and over again that the story of uninterrupted house price growth in Australia is more nuanced than that. There's been long periods of flat growth or even negative growth at certain markets at certain times. And looking at how stretched the market is now, you think we can't keep growing.
No.
So there are three reasons why we hate it. But the last reason is you can look overseas and see this policy did not work.
Yeah, so it happened in New Zealand. There was a period where you could withdraw from your KiwiSaver account, which is essentially the equivalent of your superannuation, and there was a clear correspondence to house price spikes.
More than that, the New Zealand Treasury's analysis said the benefit of this policy just went to the sellers of houses in a supply-constrained market. It's not like housing became affordable. It's not like more first home buyers or young home buyers got into housing. It's just that sellers of housing pocketed more. And that is our conclusion.
Yeah, so we'll keep an eye on this one. It's certainly going to continue to dominate political headlines, I'm sure, as we get closer to the election. But yeah, keen to hear your views. Join us in the Facebook discussion group. Would love to hear what you think of the policy. But also, there's a link in the show notes if you are not yet subscribed to our daily newsletter, where we'll send you the news headlines that are important and matter to you, as well as questions from the community answered by experts. So make sure you sign up to that. So Ren, you said at the top, we are going to be calling Nick Cregan, portfolio manager and partner at Fairlight Asset Management. Now, for transparency, Alec and I are both invested in the Fairlight Asset Small Caps Global Fund. But we wanted to give him a call because it follows on from a story we spoke about a couple of weeks ago on the news that REA here in Australia has put in a bid to buy Rightmove over in the UK.
Yeah, so REA is the owner of realestate.com.au, the dominant real estate listings portal here in Australia. Rightmove is the dominant listings portal over in the UK.
Yes.
And we read that Fairlight was an investor in Rightmove from well before all of this happening. And so we wanted to, I guess, understand the story a little bit more, why REA might find it attractive, and just what is going on with this UK company. So we went to one of our favourite investors to help us break it down.
Nick, welcome to Equity Mates.
Thank you very much. Great to be talking to you guys again.
Yes, great to have you back on. Now, we're here to talk about Rightmove, but before we dig into that specifically, REA gets a great rap here in Australia, and you guys are looking around the world globally at businesses like REA. So what are some of your observations about these real estate portals globally? What characteristics make them so attractive?
Yeah, that's a really good question. So I think the first observation here is that in the developed world, we actually can't find any examples outside of two, which I'll speak to in a moment, where the number one property portal has ever been supplanted by the number two. So the equivalent of Domain overtaking REA in traffic and inventory numbers and becoming the number one property portal. The only two places where we've sort of seen that is in Russia, and I think we can put a swift line through Russia. And the other spot's regional France, where there's a sort of horizontal marketplace that came in, but not in the major city. So the first port of call is that these are widely considered, and I think quite rightly, to be almost like the old newspaper models. Essentially, that's what they've become, right? They're the old classifieds pages of a regional monopoly, which was an old newspaper, and they've really stripped out the property section of that. And there's very good reasons for why these businesses become sort of duopolies, but a very distant second in most markets. So that would be the first observation about the market generally. It's a very attractive one around the world.
Wow. Do you attribute that phenomenon to just like really strong like network effects, that like once the platform becomes so valuable, it's so much more valuable than anything that comes after it?
Yeah, 100%. And you can kind of think of the consumer behaviour here, where it's normally for 99% of people, your house is going to be your most valuable asset. And you go down to your local real estate agent and you say, look, I'm looking to sell my house. And he says to you, well, we're not going to use realestate.com. And you say, well, you're fired. I'm going to go to the next bloke, because we know that's where all the eyeballs are. That's where all the potential buyers are. And so that virtual circle just becomes stronger and stronger, as it does for all these network businesses, where more inventory attracts more eyeballs and so on and so forth, and that compounds out over a long period of time. So nothing too revolutionary in that statement, but just a reminder of how powerful these network effects can be.
Well, that is a good segue to Rightmove, because I think for a lot of people, the first we heard of the company, well, for Aussie investors at least, the first we heard of the company was when REA was thinking about a takeover.
Yep.
But you guys had been investing in Rightmove before then.
Yep.
Everything you just said there about how powerful these number one players are,
yep.
Rightmove was a bit unloved in the British market, and perhaps wasn't seen as a market darling in the same way that REA was, despite all of those observations you made earlier. So tell us a little bit about how you came to invest in Rightmove and what made it compelling for you.
Yeah, well, it's a good point. It certainly didn't attract the same valuation as REA did in the Australian market. I think part of that's to do with the fact that the Aussie market is bereft of a high number of high quality businesses. It does have some high quality businesses here, REA being one of them, but those companies tend to get bid up to pretty unsustainable multiples in our view, and hence why I think, well, we can get into it, why REA is looking to use their script and try not to pay too much in the way in cash on a bid, because they know potentially that their equity could be overvalued, or at least very attractive to use for a deal on their behalf. But for Rightmove more specifically, very similar dynamics compared to realestate.com, the number one portal by a country mile. They don't have to pay the Google tax, which is, they don't have to be paying Google to attract traffic. It all comes direct to website. So it's a very hard model to disintermediate. And because they're not paying those costs off to Google and others, their margins have historically been around the 70% mark, which is just rude in terms of profitability. But the issue for Rightmove is that the agent numbers have been quite static, and the margins, you say, they're already enhanced. So where is your top line growth coming from? Traditionally, it had come from them upselling agents into higher modules, if you like. So, basically saying, if you want to be on the front page, you got to pay a few bucks extra. If you want to feature a property, you got to pay a few bucks extra. And so the top line was really growing fairly modestly, kind of that high single digit number. So you could almost think of it as an equity bond in some ways. It's going to give you a decent cash return. It was trading on some periods there, sort of 20 times earnings, so call it a 5 or 6% cash yield. But it was growing at 10% per annum. So if you could buy it at reasonable valuations, your baseline was pretty well protected. But the other element was that they hadn't really pulled the lever on a lot of the things that had been done around the world by other portals. And REA had done pretty well here. But things like the leasing market, the ability to generate leads for mortgages, some of the auxiliary stuff, which they really hadn't done a fantastic job on. The old CEO, Peter, was a terrific guy, but it really was a sense here that with some new blood, there could be some ability to reduce the gulf, I guess, on those auxiliary services. And that's exactly what happened. We had Johan come into the business recently and put a fairly positive but achievable plan in place for how the top line was going to accelerate a little bit. And that's kind of what we've used as the basis for our valuation. We were looking really silly there for a while because the valuation was in the high sevens. The stock was, before the bid, was trading at $5. So, it did look like a bit of a silly gap, and what have we got wrong here? But I think that undervaluation has since been realised by the market and by REA, and hence the bid. So that's a bit of a long-winded answer, but I think at realestate.com say, well, they're just following the same playbook we've done over the last 10 years. That looks pretty achievable, and if we can get that asset on a cheap price, then that probably makes a lot of sense.
And so, Nick, was the takeover ever part of your thesis when you were thinking about this investment?
We don't generally buy things for takeovers. It's a nice thing that happens from time to time because good things happen to cheap, high-quality assets. Either they go up on their own because people want to buy more shares, or strategic buyers coming in, private equity, other listed comps come in and sort of realise that value on your behalf. So we've had a number of takeovers over the years, but it's definitely not our baseline. We want to make sure that we can make money without an acquisition. It's always a nice thing as long as the price is appropriate.
Yes,
to give away assets for free either. Right?
Let's turn to the proposed takeover. We're interested to get your view on it. On one hand, REA have a great management team and a great history of executing. On the other hand, Australian businesses don't have a great track record of going to Britain. And as you mentioned earlier, if it's mainly scrip, potentially you're trading your shares in Rightmove for overvalued shares in REA. So how are you thinking about the proposed takeover? And I guess, how likely do you think it is that it happens?
You're absolutely right. Aussie businesses have got a horrific track record of going anywhere outside of Australia. So you've got to really take that with a grain of salt. Unfortunately, we export all sorts of great things, but M&A generally is not one of them. But it's a bit of a challenge. I mean, they're looking at dual listing to try and get around the idea that there's a whole bunch of Britons that don't want Aussie script, and especially if you're an index or a passive holder of some sort, that just won't work at all. You're right, and we're looking at the PE arbitrage. How attractive is that combined entity with the multiple that REA is commanding at the moment, and the lesser amount provided in cash? I think of the deal in its current form, the board was right to reject it. But if that number was kind of up towards $8, then you'd have to consider it at that point. If there was a larger cash component to it, maybe something more like 60-40, 60% cash, 40% script. But the issue there, of course, is how much debt REA wants to take on. So a deal at the moment, I think it comes out at 2.5 times net debt to EBITDA, which is very manageable for a business like REA, to be honest. If it was a private equity deal, especially back in the day when you could get these kind of multiples, they wouldn't be shy of taking this asset to sort of 5 or 6 times levered. It really sort of depends on the appetite by REA to lever up their balance sheet or issue some of their own script just to raise some cash to sweeten the deal. But either way, we'll kind of have to see what that looks like over the coming month or so.
Are there any other portals around the world that you have your eye on that you might want to draw our attention to as well?
Sure. I mean, our biggest position. It's no secret. I definitely wouldn't be telling you anything we're doing due diligence on. But one of the biggest positions in our fund is Scout 24, which is the German equivalent. So a lot of people. A lot of people know the Swedish business Hennet, and a lot of sort of global managers own that. We've owned that from time to time, but it's incredibly expensive at this point. But Scout 24, a German equivalent, growing at earnings at 15% per annum, is currently trading on 23 times earnings, which I think is about half the multiple of REA at the moment. So we think that's pretty interesting. But the other thing everyone should keep an eye on is the actions of CoStar.
Okay.
For those that aren't familiar. Business that's run out of the US, managed by a guy called Andy Florence, who was the founder of the business. So I can't quite work him out because it looks like he sold down all his equity, but he still runs it like a maniac. But essentially, he's trying to disrupt the American business, and so he's going up against Zillow, where things are a little bit easier because you've got what's called the local MLS system, which is a ability to get a toehold into the market by buying inventory, so you don't have that sort of network effect problem to kind of break into. But he's also bought the number 3 competitor in the UK and doing a reasonable job of moving them into the number 2 position. So hence why the shares in Rightmove had been under some pressure and before this bid. And that's definitely something for investors to keep in mind and keep an eye on, because CoStar, whilst it's a big ask to disrupt the market, they aren't shy. So they'll spend a lot of money to give it a crack, and definitely something worth keeping an eye on for these global property portals in general, and see if that little lesson that I mentioned at the beginning, that they haven't been disrupted yet, but you never say never. So we'll keep an eye on CoStar too.
Love it. Well, thank you so much, Nick. Ren and I both love talking to you and the team from Fairlight. It constantly amazes us the breadth and depth of knowledge you have on industries globally. So we always get some insight on companies we've never heard of before. So absolutely appreciate you coming on. That was great. Thank you.
Always a pleasure catching up with you guys, and looking forward to the next time.
Thanks, Nick.
Well, we're going to take a very quick break, and on the other side, we will be back with another Pimp My Portfolio with Luke and a community member. And a reminder, if you would like to submit to Pimp My Portfolio or ask us a question or just any sort of comms with us, head to equitymates.com/contact. We'll be right back. All right, it is time for...
This is Pimp My Portfolio. Pimp My Portfolio.
Favourite part of the episode. We've got an expert in the studio. We've got a listener on the line to do Pimp My Portfolio, where community members submit their portfolios to hopefully get an expert provide a little bit of support and advice. And we have in the studio our expert for today, Luke Laretive from Seneca. Luke, how are you?
Bryce, how are you?
Good, mate. And on the line, we have Christy.
Ren's not here, apparently.
I am here as well.
Ren's part of the episode.
Christy, great. Thanks for joining us today.
Hi guys, good to talk to you.
No, we're looking forward to this one. So, Ren, as always, give us the details. What's in Christy's portfolio?
Okay, so Christy's portfolio is anchored by 3 big ETFs. The Vanguard International shares at 27% of the portfolio, Vanguard Aussie shares 29% of the portfolio, and the Vanguard High Yield at 21% of the portfolio. A couple of other ETFs, NDQ and Vanguard Aussie Property, and then 3 stocks, BHP and Fortescue, and then a smaller Woodside holding. And Christy, I don't want to be presumptuous, but I'm guessing the Woodside holding came from the BHP sale and share split.
It did, that's right.
Nice.
Great. Now, as we always like to start, Luke will give the portfolio a nickname.
All right, Luke, what have we got?
This is called the Sandgroper Special.
The Sandgroper Special?
What is
that?
What's that?
So a sandgroper
It's
for
a
all the
fish?
It's the Western Australians will know it's like a nickname for Western Australians.
Okay.
Because
Okay.
and
Christy, are you from Western Australia?
I'm not actually.
it's only because you've got the
From Sydney.
I'm guessing
Luke
because you've
is
got...
from Western Australia.
so because you've got Fortescue, BHP, Woodside.
Yeah,
you know.
Okay.
I told you guys I've got no creativity. I'm running dry on names, so really battling.
Good. Credit where credit's due. You got to keep coming up with them. But perhaps, Christy, we start with you. Can you just run us through how you've come to build your portfolio?
Look, it's kind of in a bit of a transition at the moment, actually. When I started, I did have a lot of big individual stock holdings. But after I've had kids, I just don't have the time to maintain that so much anymore. So I have been selling out of them and sort of transitioning more into just having ETFs for having something lower maintenance. And I know it looks like I'm super into resources, but they're actually sort of leftovers that I haven't sold out of yet. These ones I bought using a small amount of debt recycling, and I haven't sort of figured out what it means to sell those.
Yep.
So they're kind of ones I'm procrastinating on. I know that I don't really want to keep holding them, but I'm not sure when's the right time to sell out. And they have returned better than some of my other holdings too. So I've kind of procrastinated on selling for that reason too.
Yeah, I think that's something that people get caught with sometimes with direct shares. They should return better than your whole portfolio, like than a diversified portfolio, because it's concentrated. So if they're not doing that, it's obviously not a good investment. But by the same token, you know, holding individual shares, if you get lucky, you buy them at the right time, you will make money. So, and you'll make more money than you would in the short term than holding a VAS or other international ETFs. So I can see why people get caught in that transition, as you called it, Christy. So, look, my overriding comments are: this is pretty slick, pretty good, pretty happy with this overall.
Jeez, I'd be taking that, Christy.
That's quite rare, isn't it?
It's rare. You know I'm a bastard.
How about we just finish here?
Yeah, Luke's
let's finish on a high.
for Luke.
That's about as good as you're going to get from me. So, especially for an ETF portfolio, right?
Nice.
So, I would say that you can probably simplify here if you wanted to. Now, you don't have to, but there's not really any need to hold, in my opinion, particularly if this is a growth portfolio, a portfolio that's designed to go up, to buy Australian property or Australian high yield. I think that money, you can just think about it as, okay, how much money do I want in international shares? How much money do I want in Australian shares? 60-40 or international favour would be totally fine. You pick a number, Christy. It doesn't really matter. You could pick 100% international as far as I'm concerned, as long as it's not just 100% Australia. I'm happy with it. And look to just say, okay, well, I'm just going to do the VGS and the VAS, and that would be totally fine. You could do something like the VDHG, which I know you're familiar with, and then if you wanted to, do anything on the side, which I would not necessarily advocate for. You could pick one or two other things that you're interested in. From my perspective, a portfolio, if someone came to me with a portfolio, 60% MSCI All World Index of their choosing, 40% some diversified Australian shares through ASX 300 benchmark thing, it's fine.
Perfect.
You don't need anything else. Yeah, that's going to do the job for you. And I don't really see a reason to own, an NDQ or any of that sort of stuff as well. It's going to get rolled up in the big international one, and you're going to play that more. What would you call proper index investing, proper market cap, 5,000 stocks type stuff, not 100 stocks. Because NDQ to me is correlated. It's not necessarily. It feels safe, but it ain't.
Yeah, I think the key thing there, Christy, is the Vanguard Aussie Shares and Vanguard Aussie Shares High Yield, very similar companies, and then the companies that are in the Beta Shares Nasdaq 100, the companies that are at the top of that are also at the top of the international index. So there's an argument that you could simplify your portfolio even further. But I think, as we said, that's glowing from Luke.
That is amazing. Do you have any questions off the back of that comment from Luke, Christy?
No, I don't think so. I think that's given me some really good things to think about. I've kind of gone back and forth when I first started buying on whether I was going to be a dividend investor or a growth investor, and I think that's where I've ended up with some of the duplication. Mm-hmm. So it's good to think about keeping on simplifying that and maybe doing that a bit further as well.
Nothing wrong with dividends, nothing wrong with reinvesting them and continuing to grow that way.
Aussie stocks pay so high
So
dividends
dividends.
anyway. Like
Correct.
you're going to get great dividend from.
You get 3.5%, 4% just on the whole index.
You don't need to
So-
go high yield to get dividends from the Aussie market. So
And as I've said before, high yield companies are generally not going to grow as fast because they're going to pay out more of their profits to you as a shareholder and less in their business. And you can only reinvest them at whatever the rate of return of your portfolio is, or in the cash rate at 4.5%. They might be able to reinvest at 20s and 30% return on invested capital. So I'd much rather give it back to them and say, hey, go and get me another 30%.
Christy, I'm sitting here absolutely stunned because we've done a number of these Pimp My Portfolios with Luke, and he will take every opportunity to talk about active management. And this felt like a absolute layup to talk about active management.
I could have done it.
Because you've got a really
don't
good.
give him a layup.
You've got. I think because I think it's worth the conversation. It's
Okay.
like you've got a really good building blocks of like index, large cap stocks with what you've got, but there are pockets of the market that you don't have a lot of exposure to. Emerging markets, small caps, stuff like that, where active managers really excel. So I'm interested to hear Luke's take on, could active management play a role in his portfolio?
Without straying into the realms of personal advice, Christy did preface the conversation by saying she's had a family. She's trying to reduce the hassle of running a share portfolio. She's trying to spend as little time doing this as humanly possible. So look, it depends. Sure, would the portfolio we've just discussed look like my portfolio? No, it looks nothing like what I do with my own money. And would I do this with my own money? No, never. But the reality is it okay? Sure, totally fine. Like there's lots of ways to skin the cat, and just because it's not what I do with my money doesn't mean I'm the arbiter of truth here. So, are there things you can do to generate better risk-adjusted returns, Christy? Yeah, sure there are. Is it maybe not the time to be worried about those at the moment and generating the best returns you can possibly do? Well, look, without asterisk general advice, but probably not. So by the sounds of it, so that would be why I avoided doing my usual active management rant, is because unlike you, Bryce, I listen to the clients.
Nice. Well, I mean, yeah, I think that's pretty straightforward, Christy. It sounds like from Luke's point of view, you're very much on track. If you wanted to make life even easier, then solidifying a few of those ETFs, particularly that have Australian exposure, more into the international, could be beneficial. But I mean, overall, you can't really complain with the glowing reviews that have come from Luke. I think to your point though on what to do with those other three stocks, we can't really say from a personal advice point of view. There's probably tax implications there.
Bryce and I have just taken our first step on the property journey. We're not up to the recycling equity part of that.
Yeah.
So congratulations on being there.
Except I've left myself in a mess. now.
No, I'm sure you're fine. I can't even spell debt recycling, so that's it.
And we didn't get to it today, Christy, but I think one other thing you should be commended on is thinking about building a portfolio for your kids and starting to invest, or starting to think about how you can invest with them. And I think that's so important. So well done on that as well.
There's no reason that your portfolio should look any different to your kids. For my nephews, I don't have kids, but for my nephews, I invest in the exact same portfolio of shares as what I own. It's exactly the same. So, and I don't see why it would be any different.
Nice one.
Nice. Well, Christy, I hope you got something out of that conversation to think about. If you would like to chat to Luke more formally, we can make the introduction. Or if you're at home listening and would like to submit to Pimp My Portfolio or be connected with Luke or any of our other advisors, head to equitymates.com/advice and we'll make sure we put you in touch. But Christy, thank you so much. We really appreciate you coming on today and sharing your journey with the Equity Mates community. Thank you so much.
No worries. Thanks, guys. That was great.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.